Hello and welcome to Capital Markets and the Security Analysis for Ethiopia. This is Mathematics for Capital Markets. This is video 7. I am Balai. In the previous, we have discussed different issues starting from the definition of financial markets and the types of financial markets and the types of financial assets and so on. Today we are going to see mathematics part. Financial mathematics is the application of mathematical methods to financial problem. It can be called as quantitative finance, or we can call it financial engineering and the like. It draws on tools from probabilities or statistics or stochastic process and economic theory. Under financial mathematics, we have to see time value concepts because it is the main part that we have to know under mathematics for finance. In finance, the phrase time value of money indicates a relationship between time and money that any currency such as dollar or euro or other received today is worth more than the currency promised at some time in the future. But why such is happened? What is the reason behind? This and other will be discussed under the following presentation. Let us see. The main reason includes opportunity cost or opportunity you lost, inflation or change of price, risk and uncertainty of things in the future, and consumption preference or our wants, our interests. When we see the first reason is opportunity costs. This is money today can be invested to earn a return. That means in saving accounts or stock or business. Example, if you have $100 today and invest it at 5% annual interest, in a year you will have $105. If you wait a year to receive $100, you miss that opportunity, that is $5. This is what opportunity costs says. The second reason is inflation. Over time, price rise or inflation, so the purchasing power of money decrease. For that example, $100 today may buy more than $100 a year from now. This is the impact of inflation, or how inflation is the main reason for time value of money. The third one is risk and uncertainty. The future is uncertain. If there is uncertainty, there is a risk. So there is always a chance you will not receive the money in the future due to the default, for example. If no payback, or if borrower is not pay for you, or delays or economic issues, economic up and the down issues, financial crisis, for example, the economic crisis, the recession, and the like. Money today is certain, or future money is not guaranteed. We are certain for money of today or money we have on our hands. But we have no guarantee to or for the money in the future. Because of that, a risk and uncertainty is the main reason for time value concepts. The other one is consumption preferences. People or society generally prefer to consume now rather than later. $1 today allows you to buy something now, which is usually more desirable. This is consumption preference views. The other one is basic time value concept. Under this, let us see application of it. Under application, we can use or analyze in the evaluations of financial security. This is how time value of money can use in analysis and evaluation of financial security. The other for investment decision or capital budgeting. The other financing or fundraising decisions. This also depending on time value of money. The other lease, pension, and other posts, retirement benefits, sinking funds, business combinations, and installment contracts, and also others, which is not included under my PowerPoints. After saying this, let us see the nature of interest rates. Since interest rate is cost of capital for our monies, since time value of money is related with cost of capital or interest rates, we have to know the nature of the interest rates. Interest rate is the payment for the use of money, or it is the price of money or capital you used. It is excess cash received or repaid over the amount borrowed or the original money, that is principal. Elements involved in financing transactions include principal, this is original money, amount borrowed or invested, interest rate, this is a percentage or the rates, time, this is the number of years or portion of the year that principal is outstanding or principal is stayed with the borrower or is stayed as a receivable and the like. By having these views or having these ideas, that means about interest rates, let us see types of interest rates. We have a simple interest rates that we calculate directly on the principal, and also we have compound interests that we calculate interest of the interest. We will see by using example. For now, let us see simple interests. Interest computed or calculated on the principal only. It is not calculated or computed on interests, but it is calculated only on principal. Example 1, Bona borrows $20,000 for 3 years at the rate of 7% per year. Compute the total interest to be paid for 3 years. This is for 3 years. Solution: interest rate is equal to principal times rate times number of years, that is n. This is $20,000 times 7% times 3 these years. The interest for 3 years, and that we calculate on $20,000 is $4,200. This is for 3 years. When you add up both principal as well as interest rates, you can get 24,200 including your principal. Example 2. Bona borrows the same amount as for the same years and with the same interest rate, that is 7%. Compute the total interest to be paid for 1 year. The calculation is the same, but the difference is years. This is only you can calculate for 1 year. Solution: interest rate is equal to principal, that is 20,000, times interest, that is 7%, times years. Year is 1, not 3. Now only what amount of interest you can get for only 1 year. It become $1,400. This is for 1 year. What about for 2 years? $2,800. What about for 3 years? We have discussed before. This is how can we calculate our interests. The third example is how can we calculate partial year interest rates. On March 31, 2011, Bona borrowed 20,000 for 3 years at the rate of 7% per year. The given is the same, but the difference is partial years. Compute the total interest to be paid for a year ended December 31, 2011. Partial year interest is equal to price times interest times n. Now our attention should be on number of years. The number of years is no full years. It starts from March 31 to December 31. So we have to count the months and divide it for 12 months. This is to change into 1 year or 2 years. So it is not 1 year, but it is 9 months. Then we can divide 9 months for 12 or 1 years. And we can get n amounts. That is how can we calculate partial year interest rates. Then it become $1,050. Have you seen how can we calculate partial year interest rates? For example, it may be only for 6 months, only for 3 months, if that is quarterly, we will see everything in the future. Or we can calculate for 2 months. That is how we can calculate a partial year interest rates. We have to divide it for a number of months in the year to calculate partial year interest rates. And also we can calculate daily for 3 days or 4 days by taking into account a days, that is 365. Okay, we will see it. The above one is how can we calculate simple interest rates. Now let us see the second types of interest rates, that is compound interest rates. This compound interest rate is called as calculating interest of the interest, not only principal. We will add interests or at the end of the months or the end of the years, and for the next year or the next month, the interest become principal, and we can calculate another interest from the interests. Compound interests compute interests on the principal as well as any interest in it that has not been paid or withdrawn. Most business situations use compound interests. Example: worker deposits $10,000 in public bank where it will earn simple interest of 9% per year. it deposit another $10,000 in the private bank, where it will earn compound interest of 9% per year, compounded annually, not simple interest. In both cases, work will not withdraw any interest until 3 years from the date of the deposits. Then we have to calculate both or under both scenarios, and we have to see what is the difference and how this difference is occurred. All of this is calculated in the next videos, that is under video 8. Okay, for this you have to try it and come with the results, and please put your result or outputs or your answer on comments. I will see that, and also with the next we will calculate together and we will see. Even though it is simple, you can try. With this, we come to the end of today's program, and I thank you for your views. Please, if you like, subscribe also to my YouTube, and share it for others of your friends if you think it is useful. The next time we will learn calculation of EATs, that is time values, and other calculations regarding this mathematics for finance. My YouTube is, as you see, you can subscribe if you think it is interest, otherwise no problem. Thank you.